From the screens we stare at all day to the cutting edge of national security, it's the humble semiconductor chip that truly runs our world. But America's once unrivaled command over its production is fading. So how do we regain our crucial edge, and why is it so incredibly urgent? For decades, America led the world in innovation and, well, manufacturing too. But lately, we've seen a shift, especially in critical sectors. That's why today's news is so significant. On August 14th, 2025, Intel Corporation's shares didn't just inch up, they surged over 7% in regular trading. This wasn't just, typical market chatter. It was directly fueled by breaking reports that the U.S. government is actively considering acquiring a direct equity stake in Intel.
That's right, and this really is quite a landmark moment. We're not talking about your typical government grants or loans, which, well, we've certainly seen before. This result suggests the government could take partial ownership, specifically to support Intel's massive $28 billion chip manufacturing complex in Ohio. That's a project not even slated for full completion until the 2030s.
So this isn't just a financial investment, it's a profound statement, isn't it? Why such a drastic kind of unprecedented move? What does it signal about where America is heading with its industrial policy?
Precisely. It signals a fundamental shift. Semiconductors are absolutely vital for, well, everything. From our smartphones to advanced military systems, they are right at the core of national security and economic competitiveness. And while U.S. headquartered companies still represent about 47% of global semiconductor sales, that impressive figure, it hides a critical vulnerability.
Which is?
The United States itself possesses only 10% of the world's installed manufacturing capacity. Only 10%. That's a huge disconnect.
Wow. And that disconnect creates significant geopolitical risk, doesn't it? It highlights the urgent, almost existential need for a robust domestic supply chain. So the strategic maneuver shows a more interventionist approach, clearly prioritizing domestic production and national security over purely free market principles. It's a bold attempt to reverse decades of declining domestic manufacturing capacity, making sure we're not beholden to foreign shores for these indispensable components.
Exactly. We're witnessing a strategic pivot.
So, today, our deep dive is into this urgent and complex challenge: how America can strengthen its semiconductor industry. We're going to explore why this tiny technology is so critical, the existing vulnerabilities that put us at risk, and how a new strategic approach, one that creatively leverages both government and private sector strengths, aims to rebuild our leadership. The ultimate mission here is to ensure a resilient, competitive, and truly market-driven U.S. semiconductor industry for decades to come, bringing back high-tech jobs and vital production. Okay, let's really dig into what our sources call the chip problem. Understanding America's core semiconductor vulnerability. We touched on it, but let's be blunt. The numbers are stark. U.S. headquartered companies, names like Intel, that they lead in design and sales, holding about 47% of global semiconductor sales. That sounds like a winning hand, right?
It sounds good on paper, yeah. But here's the critical weakness that truly puts us at risk.
Yeah.
The actual manufacturing capacity within the United States is only 10% of the world's total. Think about that. Nearly half the sales, but only 1/10 of the actual physical production happening on our own soil. This massive imbalance doesn't just create economic challenges, it's a significant geopolitical risk. I mean, if a crisis disrupted supply chains elsewhere.
Our economy, our defense,
Yeah,
it would be dangerously exposed.
exactly.
And it's not just where the factories are located, it's also about the speed and the cost of getting them up and running. The sources revealed that constructing and ramping up these massive fabrication plants, or fabs, in the United States can take up to a year longer than in Asia. A whole year.
That's what some are calling a self-inflicted slow pace, and it's absolutely crippling. Looking at the data, the average U.S.-based semiconductor facility took, well, a staggering 38% longer to construct between 2010 and 2020 compared to the decade before that, 1990 to 2000. This slowdown isn't just an inconvenience. It costs billions in lost opportunities and, frankly, squandered technology leadership. When you're talking about leading-edge semiconductors, a 9 to 12-month head start holds enormous financial and strategic value globally. Every day of delay means we're falling further behind.
And beyond the sheer cost and time of construction, there's a foundational issue, right? A serious talent gap. The country simply doesn't have enough highly skilled engineers to build, manage, and innovate within these cutting-edge manufacturing facilities. We also see too few entrepreneurs, professors, and venture capitalists willing to take the kind of long-term risks required for future semiconductor technologies. It's not just a shortage, it's a pipeline problem.
Precisely. You can have all the money in the world, but without the human capital, the brilliant minds and skilled hands to design, build, and operate these complex fabs, Well, that investment won't translate into sustained leadership. It's a critical element in the overall equation, a true bottleneck.
So if the traditional approaches aren't working and we're facing these stark challenges, what's the blueprint for this new American strategy that aims to go beyond just, throwing money at the problem? The sources suggest that policy must be smart. It has to recognize that competitive advantages come from deepening existing U.S. strengths, not by simply trying to imitate what other countries are doing.
Exactly. The role of government funding here isn't about dictating winners or propping up failing industries. No. Instead, it's envisioned as a catalyst strategically deployed capital to reverse these detrimental trends, to create an environment where American ingenuity and private enterprise can flourish. It's about building a stronger foundation for the entire industry, not picking favorites. It's about empowering the market, not replacing it.
And a major pillar of this strategy seems to be accelerating deployment and accumulating talent. For the workforce, that means a clear, urgent need for targeted and accelerated immigration to address the engineer shortage we just discussed. Plus, a concerted nationwide effort to inspire American talent to study hard sciences, electrical, mechanical, optical engineering, material science, the very fields vital to this industry.
The goals here are ambitious, yeah, but absolutely essential for long-term self-sufficiency. To double annual PhD hires and increase the U.S. job base in this sector by more than 25%. This isn't a quick fix. It's a multi-generational investment in our intellectual capital and our industrial future. We need to be producing the best and brightest right here at home.
Okay, then there's the critical issue of streamlining processes. This is an area where, conservative principles of efficiency and common sense can really shine. The U.S. is identified as one of the most expensive and slowest countries in which to build these massive manufacturing facilities. That means we're essentially taxing ourselves with needless bureaucracy.
Absolutely. And the sources lay out some common sense steps that could drastically accelerate construction. Imagine having a single point of contact within the government. Someone to coordinate and streamline all the regulatory engagement for a semiconductor company. That alone would cut through endless red tape.
Makes sense.
It also means actively identifying and, frankly, deleting duplicative federal reviews and procedures that just add layers of delay without real benefit. And perhaps most critically, it means fostering a problem-solving culture by sharing best practices with state and local officials, transforming the entire permitting and approval process.
It's about recognizing that speed is a core competitive factor, isn't it?
Mhm.
The sources even suggest we should benchmark global leaders like Japan and Singapore, learn from their speedy semiconductor starts and adopt their most effective strategies. The big, audacious goal here is to slash that time-to-market gap from over 40% down to less than 20%, maybe even cutting the time from initial inquiry to installed tools on the factory floor in half. Think of the billions saved, the competitive advantage gained.
That kind of efficiency? It directly translates into faster returns on investment for companies. It makes the U.S. a far more attractive and, frankly, logical place to build and expand. It's about removing the unnecessary burdens that have made us less competitive over the years.
Now, let's talk about the financial engine driving this transformation. This new strategy envisions truly powerful public-private partnerships. The existing $52 billion U.S. semiconductor fund, while significant, is seen as only a starting point.
Oh yeah, the real goal is far more ambitious, to
Mhm.
sustainably grow funding to maybe $250 billion or even more. But crucially, by generating massive co-investment from third-party partners. This means using taxpayer dollars not as a bottomless pit, but as smart seed money, a catalyst to attract significantly larger amounts of private capital. It's about multiplying the impact of every single public dollar.
And they're looking at diverse investors, right? Making sure every segment of the capital markets is engaged. Private equity, for example, is seen as a logical partner for manufacturing capacity. While PE typically seeks those, high teens returns, government support and reduced risk could attract them at a slightly lower but still attractive, maybe 14, 16% gross returns. Seems like a sweet spot.
Exactly. And then there are debt lenders, a potentially enormous source of low-cost capital. The proposal here is truly innovative, a new TALF-like facility. It's modeled on successful programs during the Obama and Trump administrations. The idea is for a relatively small amount, say $5 billion from the Semiconductor Fund, to essentially seed or provide the foundational backing for a Federal Reserve's TALF 3.0. This acts like a magnet, providing incredible 12.5 to 1 leverage.
So, if I'm getting this right, that means a relatively modest government investment acts as an anchor, drawing in a massive amount of low-cost private capital. We're talking about making it possible for chip companies to access loans at incredibly favorable rates far below market thanks to this public backing, leveraging every taxpayer dollar significantly.
Exactly right. This mechanism could attract an additional $120 billion at the top of the capital structure. It offers attractive low-teen returns to investors while providing semiconductor companies with financing potentially as low as 2.50%. It's a brilliant way to make a little go a long, long way.
Okay, and here's where it gets really interesting for taxpayers, ensuring this isn't just another handout. The STARP model, that's the Semiconductor Technology Asset Revival Program, it would be blended into these investment capital stacks, and it's explicitly modeled on TARP, the Troubled Asset Relief Program, which, as you mentioned, was successful in recapitalizing banks and famously returned money to taxpayers.
This is key for accountability and fiscal responsibility. STARP would enable, say, $70 billion of private equity capital to invest, but, and this is crucial, on a subordinated basis to U.S. taxpayers. What that means is taxpayers are first in line for repayment, almost like getting preferred shareholder status. This structure is designed to protect public funds, making sure taxpayers are paid back first, potentially in 79 years, maybe even sooner, through refinancing. It's about leveraging private investment while rigorously protecting public money.
Got it. And finally, venture capital. That's crucial for the very early stage innovations and then later for the commercialization investments, fostering that dynamism and technology experimentation that America is known for. So the investment criteria for all this capital sound quite transparent and fiscally sound. The capital must advance America's interest in these top 10 objectives. It must return taxpayer money and generate a profit. It needs to attract private capital where there are limited-led investors, and it should support both American and critical foreign companies, recognizing how interconnected this industry really is.
It's a pragmatic approach, yeah, focusing on tangible returns and strategic outcomes, not just spending for the sake of it.
All this ambitious funding and strategic deployment requires a dedicated, highly skilled government team, though, because it's not just about money, it's about smart, long-term execution. The sources emphasize that this team must be hybrid, recruited from semiconductor, financial, and policy spheres. They need to understand the industry from every angle.
Critically, this team needs to be insulated, probably via legislative action, from short-term political considerations, while still maintaining oversight from elected leaders, of course. This independence is vital for consistency. It needs to operate through different administrations and industry cycles to ensure that consistency and long-term commitment, like a specialized unit focused solely on this vital mission, unswayed by, the shifting winds of politics.
And they propose emulating the highly successful Overseas Private Investment Corporation, OPIC, which is now the DFC, the Development Finance Corporation model. OPIC was a bipartisan political success, allocating over $177 billion in investments and, remarkably, returning $5.9 billion in gains to taxpayers. It truly harnessed the best of American companies to create a self-sustaining, synergistic public-private partnership. That sounds like a powerful model to replicate.
It absolutely is. This new semiconductor fund would function as a single point of contact for the industry, making it far easier for companies to navigate. It would be designed to attract top talent, have global reach for essential partnerships, develop deep industry insights, and critically, deliver a triple bottom line, generating money, strengthening the industry, and creating high-quality American jobs, all while moving quickly and ensuring structural independence. It makes a very practical, results-oriented approach to government-industry collaboration that respects taxpayer dollars.
Okay, shifting to the global stage. This strategy emphasizes global partnerships, American leadership, while consciously avoiding blunt nationalist or protectionist policies. The focus, as our sources suggest, should be on aptly playing to America's strengths and creating a competitive ecosystem right here at home, rather than resorting to the kind of protectionist policies that have, well, failed in the past.
Success absolutely requires leading global companies, names like TSMC from Taiwan, Samsung, Infineon, and ASML, to not just manufacture but also conduct their cutting-edge R&D at scale in the U.S. They need to see the U.S. as a genuine second home, a place where they can thrive long-term. This requires significant inducements, attractive financial incentives, low-cost capital, targeted tax incentives, and a long-term, stable commitment from the U.S. government.
Right. Access to a robust network of suppliers and intellectual property, plus absolute certainty for their return on investment, those are also key factors for these global giants. And while manufacturing is important, attracting R&D investment is even more challenging, isn't it? But essential for continuous innovation. This means R&D tax credits and ironclad guarantees of free intellectual property transfer are critical incentives to keep innovation flowing here.
And regarding China policy, the sources suggest a very clear separation. They argue that national security, export control, economic security policies concerning China, well, they should be handled via mechanisms and teams completely independent from this new semiconductor fund.
That's a very careful distinction. Why is it so crucial, in the view of these sources, to keep the investment fund entirely separate from the broader China policy, especially given how intertwined global tech is?
Well, it's mainly about preventing the investment fund from becoming a political tool or being hampered by security concerns that might deter crucial global partners, partners who are absolutely essential for this industry's health. By keeping them distinct, the fund can focus purely on its economic growth and strategic investment goals. Meanwhile, national security policies can be robustly applied without muddying the waters of capital attraction. The sources even note there's a bona fide argument that inviting Chinese companies to participate in the fund's investment programs could actually subject them to greater oversight and transparency. So it highlights a nuanced approach, separating direct economic investment incentives from broader geopolitical considerations.
Okay. So, what does this all mean for the path forward? What are the immediate priorities? The initial investment focus, our sources highlight, should be on leading edge logic, lagging edge logic, and specific memory segments like DRAM, where the U.S. currently lacks leading edge manufacturing. These are the absolute brains of the technology ecosystem, powering everything from our daily devices to advanced AI and cloud computing.
And it's vital that investment in new facilities is coupled with genuine manufacturing innovation. This means focusing on advanced automation, yield improvement, things like that, to overcome cost disadvantages inherent in U.S. production. Without this, the risk is creating a manufacturing base that needs perpetual government subsidies just to survive, which is simply not sustainable or fiscally responsible in the long term. It's about building a self-reliant industry.
This entire effort is being called a once-in-a-generation opportunity. It could truly make the semiconductor industry a powerful model for public-private partnerships across other vital American industries. Tapping into the strengths of American workers, our world-class educational institutions, and hopefully a newly agile government framework. It's a chance to apply the lessons learned here to other critical sectors.
It's about leveraging our unique strengths, our dynamic capital markets, our entrepreneurial spirit, our educational institutions, to strategically address a critical national vulnerability. It represents a pathway to not just recovery, but true leadership.
So we've unpacked how bolstering America's semiconductor industry isn't just about producing tiny chips. It's about national security, economic resilience, and a profound strategic reinvention of how government and the private sector can collaborate effectively and responsibly. It's about ensuring U.S. leadership in foundational technologies and doing so by attracting vast private capital, strategically cutting red tape, and recruiting the best talent.
Yeah, and this deep dive really reveals a fundamental question for our future. Can a focused, disciplined government partnership with industry aimed at specific critical sectors truly reignite American manufacturing and innovation? Can it prove that targeted intervention, when done strategically with an eye towards fiscal prudence and protecting taxpayer dollars, can actually unleash capitalist ingenuity for the collective good?
What areas beyond semiconductors might benefit from a similar results-oriented approach? An approach that prioritizes national strength, global competitiveness, and undeniable taxpayer value. It's a question worth pondering as we look to the future of American industrial policy and one that could redefine our economic landscape for decades to come.